Hello and welcome to Trading the Trend. My name is James Boyd. We welcome all of you here today. My good friend Brent Moores is in the chat, fellow instructor. We welcome him. And also we have Bharat Villager, PR 451, Jay Richardson, Frank, and many others. Welcome to all. Some of you said that you're in some colder temperatures. You look behind me, it is slight snow flurries. Hasn't stuck at all. I haven't even used the snow blower at all this year. Not bad. So hopefully that continues. Now, just real quick as we get started, remember we want to talk about trading the trend. And so we're going to use stocks, obviously, but we will also bring up occasionally, in some examples, options. Remember when we talk about stocks, but specifically options, remember that options carry a high level of risk, not suitable for all investors. Our focus that we're going to talk about here today with options is mainly going to be really married puts. So when I say married puts, we're talking about buying the stock and then buying the put at the same time we buy the stock. We'll talk about why are we bringing out the strategy. Second, we're going to talk about kind of the profit loss movement of that. And I want to also take a look at the option Greeks on that. And it's specific to where the VIX is right now. So we'll get into that. Now, remember the information is provided for general informational purposes only. Also remember that Schwab does not recommend the use of technical analysis as a sole means of research. We saw another example here today where fundamental data from Walmart has an effect technically. So if you're just using technical analysis, you can be blindsided by fundamental factors or macro factors. So be aware of kind of earnings and the information about the economy and so on, which can change the technicals. Also remember that investing involves risk, including loss of principal. And also remember when we talk about options, we will bring up the option Greeks and how they measure a sensitivity, okay? And you can see that right in the middle, what sensitivity to what? Well, based upon whatever the Greek is, delta, gamma, vega, theta, it's measuring a different sensitivity, and we will get into that. Now, today also want to give you a quick reminder that coming up just in about 2 weeks or so, we're going to be in Scottsdale at the Phoenician, March 7th and 8th. First day is technical analysis, second day option strategies. Chicago, many of you live in Chicago, going to be at the Renaissance Schaumburg, the 21st and 22nd. And Detroit, which I heard was a little bit underwater in one of the neighborhoods, and the 11th and 12th there as well. So yeah, those winter months in those upper lake regions can be tougher, but there's tough people there. I grew up in Ithaca, New York myself, so I should know something about that. Now, also remember, if you have questions on that or where can I find more information, go to schwab.com/events. Now, just real quick as we hop in, let's kind of really talk about, in this case, kind of what are some of the things we're seeing. Now, I want to talk about the market in relationship to the current positions in the portfolio, okay? And what I want to do first, just real quick, is I'm going to bring up the paper money account, and I want to show, for example, first off, the margin account, okay? Now, tomorrow is expiration. So we have a number of examples that we need to look at in terms of when we talk about markets and sectors, what about our positions that are in the paper money account? And you're going to notice that when we look at stocks, when we look at verticals, this account, a lower dollar account, is quite heavily invested in verticals. And there's a number of these ITMs there that we need to address. So someone asked, could you show me the positions? These are the positions in the margin account, which I'll open. And then when you take a look at, let's say, the IRA, you're going to see that these are the positions, and I'll close all those. And there's going to be a couple there that we need to address here, like that one, and so on. And we'll get to that. Now, first off, let's go to just real quick kind of where the market is and how it relates to the positions in the portfolio. Let's go to just real quick. Let's start with the Dow, okay? The Dow was not the leader. It's been struggling about the last 2 weeks or so. Today, Walmart took a leg lower, okay? And if you look at Walmart, and I'm over here on the left-hand side, Walmart down 662. And what you're going to notice is they gave cautionary guidance, okay? They said, hey, the profit margins might contract if you actually compress or squeeze the profit margins. You lower earnings per share. You lower earnings per share, you actually lower what that stock maybe could or should be worth today. So that's having an effect on really what we're seeing with Dow Jones. Now, when you pull up the Walmart stock, is it a bear market in Walmart? Well, I don't know about bear market, okay? But what you're going to see is it really is dropping back down to where the breakout happened. This is not necessarily completely unusual. Sometimes stocks can rally up to the earnings, and then on the earnings, people find reasons of why they want to sell. Now, you'll notice that gap in the price. This might kind of bring up the question of, well, one of the risks of setting stops is it's a trigger to sell the stock, but it doesn't guarantee an exact spot. So I want to kind of talk about maybe buying the stock, okay, and then buying the put. Got a couple examples I want to look at here today with that in context. Now, so Walmart dragging things down. It's also having an effect on those financials. Goldman Sachs getting pushed down. JP Morgan getting pushed down. Okay, so if you're actually having people feeling less confident on their finances, they don't swipe the debit card as much. They don't swipe the credit card as much. They don't buy maybe as much maybe in general. And so that could actually affect maybe some of the loans from some of the financial companies. And you're going to see American Express under pressure. Boeing's even down 2.75%, not breaking the trend line, but right at it. But you're also going to see that this is also having an effect on yours truly, Amazon, which we will talk about as it's been sliding down to the downside and the moving averages have been red. And there's been a red shading on that for a while. So it's not completely unusual. We always say if the price is below the moving averages, namely the 10, what's the expectation? Pain, okay? The expectation is that the price will probably struggle to go up more than 3 days before red candles come back in. We went up for 3 days, 1, 2, 3, sold. Went up for 1 day, sold. Went up for 2 days, sold. One, sold, sold. Went up for 1 day, sold. This is normal behavior, okay? So if you get the moving average, price below the moving averages, you don't tend to go up more than 3 days before the sellers come in and sell again. So you just can't get a continuance of bullish move here, okay? Now, I want to talk about just kind of maybe an area. When we take a look at this, let's say the SPX, is it lights out for the SPX? No, just kind of sitting at the old breakout area. You look at the NASDAQ itself, is it lights out? Is it the end of the world? Kind of looks like it's still on the breakout. Dow, though, it kind of, getting hurt more. Sure, it's the stocks that are in the index. And if you take a look at the Russell, not a whole lot to say outside what we already told you. There ain't a whole lot happening here, okay? So of the three majors, S&P, NASDAQ, Dow getting hurt the most. It's been getting hurt the most, okay? Today just kind of went further. Just briefly, when you look at, let's say, the sectors, healthcare getting a little push here today. Keyword is little. Probably a stronger push is on energy. Now, I got about 3 stocks I want to talk about with energy when we bring up these married put examples. And he said, I have no stinking clue what married puts are. It's just we're going to buy the shares of the stock thinking it's going to go up, and then we're going to buy the put at the same time. Now, don't worry. In your life, you've already done that before. Now, but we're just going to do it with stock, okay? And we'll talk deeply about that. So we're coming. Now, the only other sector I want to kind of bring up is two sectors. If we take a look at, let's say, the real estate sector, that's not completely falling apart, okay? That's still holding. And if you go back and look at, let's say, the IXU, the utilities, that's not necessarily falling apart either, okay? Now, when you look at financials, technology, Staples even getting hurt a little bit, but is it breaking the trend? It doesn't look like it. But it got pushed around here today, okay? But I don't see trend change on that. Just kind of more of a volatile day as the market is absorbing the news. Last one we'll bring up here before we look at examples. When you look at, let's say, dollar sign IXC, you're going to notice when you look at that communications, we are seeing a break to the downside. The moving averages have not turned red yet, okay? But you're seeing a little breakdown. We're making a lower low on communication, okay? Now, where was the higher low? The higher low was yesterday, right? The open price. And today, if we close here, that would be a lower low. So this kind of begs the question, when we see, for example, volatility ticking up a little bit, what are some strategies an investor might consider? Let's throw that out here, okay? So if we're starting to kind of see volatility tick up, what does this probably mean in English? Okay, so if we see the VIX starting to rise, well, this probably means that there's a number of stocks, and if we own them, it probably means that stocks, okay, starting to fall down. Okay, now you got to remember, when things go up, they can kind of go up together a lot of times. When things go down, they can kind of go down together. Okay, so stocks starting to fall down. You could probably get, let's say, stocks triggering stop losses. Okay, stop losses. You could get negative moving average crossovers, negative moving average crossovers. Okay, and so we're saying when the VIX starts to rise, so that could be like what we're seeing right now. Now, at the same time, some investors might say, James, I'm maybe not using stops. I might want to consider, if that VIX is starting to rise, maybe the investor might say, I'm going to maybe buy puts. Now, let's kind of bring this up. Why would the investor buy a put? Okay. Well, you got to remember where we've been. Okay. Have we been in low volatility or high volatility? Let's go back to that for just a sec. Well, we have not been in high volatility. We've been in the lower end of volatility. Why does that matter? Well, if you have low volatility, the option premiums are lower. Okay? And so meaning the stock doesn't have to go up as much to offset the cost of the put. Now, I would like to kind of use this example first off. We're going to go to ExxonMobil, okay? So number one, when the investor does this strategy, they have to really have the underlying idea that I think the stock could go up, okay? Now, obviously, when you make that comment, you're really thinking that you can identify a support level maybe over about the last 2 to 4 weeks where you say, look, I think the stock could actually go up. Now, if you zoom in on this, what you're now going to see is there's a little crossover. Crossovers don't matter as much if you're been in a range, which Exxon has. If we kind of really got more bullish, the investor might say, James, I would be more bullish, that investor says, if we got above 111.96. Okay? Now, what I'm going to do is we're going to buy the shares of the stock in the paper money account, and at the same time, we're going to buy the put. Okay? Now, how do you do that? Okay, now this is very important, okay? What we're going to do is going to go to the trade tab. We're going to type in XOM. And all we're going to do here is, first off, we're going to go up to we got the trade tab. We're going to type in XOM. We're going to buy the shares. Why would you buy the shares? Same reason why you bought the shares before. You think they're going to go higher, okay? Now, if we take a look at this, if I click on the bid, it's going to create a sell order. I don't want that. We're going to click on the ask price. Click on the ask price. There's that first row that we're buying 100 shares of stock. Now, I cannot do that in the margin account. It's going to be tight even in the IRA. We're going to see what happens, okay? Now, number two is this right here is risky in the fact that it's very sensitive to price movement. If the stock went up $5, we'd feel like a genius. If the stock went down $5, we wouldn't feel that smart, right? So the bad thing about 100 shares of stock is it's 100 shares of stock. It's sensitive to price movement. Okay, now step number two, we're going to come down to advanced order, and we're going to go to first triggers SEQ, right there. Now, when we buy a put, it's not necessarily that we're going to buy a put for 6 months or 1 year, etc. We're going to tend to buy the put just for maybe 20 to 40 days, okay? So we're going to have a starting point of the monthly option. Now, when we're doing this strategy of a married put, we tend to try to do it when the VIX is low and rising. Second, we tend to actually try to do this strategy when the implied volatility is between about 15 to 24. Does anybody know why? Does anybody know why we kind of like that implied volatility between about 15 to 24? Does anybody know why that would be the case? Now, I'll show it a variance example. This might be a more effective example of using the strategy. And you're going to see one that's polar opposite and how there's some differences, okay? Now, the reason why we're looking for stocks that have a 15 to 24 implied volatility that's annualized is because the puts are less. And you will see why that's very important in just a second. Now, when we buy the put, you're buying the put because you want a right to sell the shares if it were to decline, okay? Now, what you're now going to notice is when the implied volatility is lower, between about 15 and 24, it means the investor might be able to come in here and buy a put pretty close to where the stock is. Now, wait, is that good or bad? Is that good or bad? Well, it's not a bad thing. It's actually kind of nice, okay? Now, what I'm going to do is you got to make sure that we go first triggers SEQ, right there, and then we're going to go to the 110. Now, the delta, we pick the strike, we're going to talk about picking a delta probably between about 30 to 40, okay? So the delta, dual meaning here, okay? If the stock drops $1, the puts will go up by approximately, theoretically, 36 cents. That delta is also it's also stating what are the probabilities of the stock being below the strike, that strike, by a penny at expiration. Don't worry, we're going to talk more about that. I'm going to click on this 163, okay? Now, do we have to buy it at 163? No, if I click on the 163, it just creates a buy order, okay? Could we try to buy it for a little less, maybe $1.61? We're going to try. Now, I want to kind of run these numbers, okay? Now, if we take a look at this, I think it's going to be very helpful for us to kind of see the numbers here. So number one is we're buying 100 shares of stock, and we're going to try to buy them at $11.90, okay? Now, what you're now going to notice is we have a right, okay? We have a right to sell those shares at what price? Well, we got a right to sell those shares at 110. All right, so what's the risk on the shares for the next 29 days? Well, from there to there. So this is the stock price, okay? Stock price, and this is the long put strike price, okay? That's where we have a contractual right to sell. So the difference between those two numbers is just going to be this, and the answer is $1.90. All right. Now, we can flip it the other way, so we can actually see that if it went down, we would be losing, okay, $1.90. So what's the bad part about this? Well, that right is not free. And what you're now going to notice is we're paying $1.61. So the cost of the put, pre-commission, is also $1.61. So this is a stock loss, okay? If we add the cost of the put as well, that's $1.61, and we can see that down below. And what you're now going to notice is if we add the two together, add it up, okay? Well, if we lost on the stock and we lost on the put, we would be losing $351. Now, if you told me I lost $351, that doesn't mean anything to me because I don't know how much you bought the stock for. So I always like to look at, or investors do, if you lost $353 and the stock was, for example, on a $111 stock, some investors like to measure that in terms of percentage of the stock price. So how would you do that? Simple. You would just say, okay, if you did lose, let's say $3.51, okay, and you bought the stock for, let's say, $111.90, how much did you lose of the entry price of the stock? $3%. You called up a friend and said, man, the stock market stole my shirt. If the investor said that, and I lost 3% of the entry price of the stock, your friend would be like, I'm confused. So what actually happened? So the defined risk, not theoretical, not a maybe, is that if the stock actually goes down, okay, and I should say it like this. Let's say the stock actually goes down, and in this case, when we look at the maximum loss, you're going to see this 351. If we lose $3.51, that's 3% of the stock entry price. Let me write that just to make sure we're Everyone's clear. This is the max loss divided by the stock entry price. That is everyone with me. Now, me being the bus driver is going to stop the bus and just look back and say, are there any questions? Okay. Now, so I'm just kind of looking at the downside. I'm saying if we lost everything, we lost on the stock, we lost on the put, what's the damage? Damage, $3.51. This does not include a commission. The commission would be on the long put, not the shares. Okay? Are there any questions? Now, what I'm going to do is I'm going to bring this up and I'm going to right click on this, analyze the trade. And we know when we look at this like on the analyze tab, the diagonal line is just showing the shares of the stock. It's linear. Okay? Now, if we add the long put, what that's going to do, okay, we take a look at this and say, what does the long put do? Well, it's what you'd expect. The long put, that line stops going down at 110. Why? Does anybody know why that does that? Why does that line stop going down at 110? Stops going down because the investor has a right to sell at 110. Now, this kind of begs the question. If people are so scared about the stock market, if they were, hypothetically, why don't they buy puts? Why don't they, for example, buy puts that maybe have lower implied volatility and just see what happens? Okay, now let's kind of speak to this for just a second. What's the con of the put? Well, one of the cons of the puts is theta, negative theta. So when the investor buys the put, they pay for it and it has negative time decay. What's a pro? Well, by the way, that's a question for you. What's the pro of a protective put? Well, you could probably see two of them, well, three of them. Well, the pro of a protective put is it doesn't cap the upside. So if we get the direction right, wonder if we did, okay? It doesn't cap the upside. Hallelujah. Now, the other good side of this is it defines the risk. So that's a positive, but that doesn't mean you win. That means there's a max loss. The other thing about this, if volatility were to increase, it's Vega positive, meaning you're long the puts, and if you get volatility go up, the puts could increase in value. The third thing that's kind of interesting is if the delta on this, just to kind of point this out, it's not positive or negative, the change in the delta is 5, okay? So when you look at this, if we said, is this a bullish or a bearish position? Well, if you got positive delta, is that a bullish or bearish position? And the answer is, it's a bullish position, okay? Now, let's go back to this, okay? So if the stock were to go up $1, approximately how much does the investor make? The stock goes up $1, you got 100 shares on the stock, so you'd be up $100, but you'd be losing on the put. And that's where that $63 comes in. The long put by itself is a bearish position, okay? So you got shares of stock and a long put, and that's combining to where the delta is 63. Now, let's go back to this. So now, if the stock were to go up, so why is the investor so concerned about the long put cost? Well, we're going to get into this little thing of what's called break even. Okay? So can anyone tell me what the break even is? Okay? Well, if we bought the shares for $111.90 and we also paid, okay, let's say we paid, let's say $1.61, we need at expiration the stock to go up to $113.51. Okay? So where did you get the 111? Well, the 111.90 is what we bought the stock for. Where did you get the 161? That's what we bought the put for. So at expiration, we need the stock to be higher than 113.51 at break even. Not today, but at break even. If it's lower than that, and let me just kind of give you a little quiz. Let's say the stock is at 113 even. Did you make or lose? Well, you're down 51 cents. If the stock is, example given, at 114.51, Did you make or lose? You're up $1 or $100. If the stock is at 117.51, did you make or lose? Well, if you're at 117.51 and the break even is 113.51, you're up $4. You see how that works? Okay. Now, what I'm going to do in this is I'm going to buy the shares, buy the put at the same time. So I don't have to worry that if the stock goes down $2 tomorrow, I have to freak out. Okay, I don't have to do that. So now what I'm going to do, because why? Well, because we have the right to buy the shares at, no, wait, we got the right to buy the shares? Almost had you. You better be listening, okay? We have the right to sell the shares. Now, I want to make sure we're crystal clear on something. Crystal. The reason why having low implied volatility is important on the strategy, it's so that the investor could try to buy the put closer to the current stock price. If that strike is closer to the current stock price, the max loss is lower. That's the value of having lower implied volatility. Now, we're going to go ahead and send the order. Notice that commission right there that's on the long put. Send that. Okay, now what I want to do is I want to give you a little, I want to give you an in-class quiz, okay? So what I'm going to imagine is you pull up a stock and you said, hey, James, I'm kind of thinking about doing this on a stock example given. Now, we know that Philip Morris has been smoking hot, okay? It's been very strong. When I say Philip Morris, what's another company in the industry group? I'll give you a hint. There's a vowel. You got two letters. One's a vowel, and the last letter is O. Okay, can you guess where we're going to go? Now, sometimes the investors kind of like to see maybe a stock or two that's going up in the group. And maybe that if 2 or 3 of the stocks are going up in the group, they might pull the laggards up with them. So I'm going to give you a little quiz. And we're going to use Altria as our example. Now remember, if the investor buys the shares, clearly they want the stock to go up, okay? But we're going to buy the put as well. Well, so here it is, okay? So how do we do that? Well, if we take a look at this, we're going to go to the trade tab for just a sec. So how do we buy the shares of the stock? Just go to the ask price, okay? Now, the question you got to be thinking is, can I do this, okay? So step 1, buy the shares of stock, go to the trade tab, type in the symbol, click on the ask price. Okay, there it is, 100 shares. Now, in this example, do we need always 100 shares? In our world, example, paper money, we would like 100 shares. The minimum that we would show in our paper money account would be 70, okay? 70 minimum. But if we bought 100 shares of a $54 stock, not necessarily backbreaking, but it's $5,400, okay? Now, step 2, which expiration do we look at and strike and why? Okay? So I'm going to go out and look at the ones that are, let's say, let's go to the Septembers. Is that where we're going to go look? No, we're not going to go look at the Septembers, okay? We're going to go look at the ones that are monthly options, 20 to 40 days to expiration. And what we're going to do in this case is, which strike are we going to look at? Now, if the stock is at 54.02, and we go look at, let's say, the at-the-money strike, something as close as we can get to it, the 52.5 or 55, if we pick the strike that was below. So I like to think about that the stock is here, and the put that we're buying is the safety net below us. So if that stock drops, the long put strike is acting as the safety net. Now, think about this, okay? We buy the shares of the stock, and we buy a long put strike really far below. So the safety net is pretty far away from the entry price of the stock. So that just means the investor drops, and then hits a long put strike. So you could do that, but the problem is your max loss is going to be bigger, okay? Now, I want to go look at this and take a look at the one that's below, the long put strike that's below. And that long put strike that is below is a 52.5. Now, Is that put expensive? I don't know. We're about ready to find out. If you look at the implied volatility, are these puts expensive? Well, if they're between 15 and 24 on the implied volatility, that's in the lower bracket, okay, of, we would just say that's lower volatility. Now, let's run the numbers. So if we bought the shares, example given, 54.05, okay, and if we said, well, the long put strike that we're going to do, now don't forget single order first triggers SEQ, and we're going to click on now the long put that we want to buy, okay? I'm going to tell you right now, when you learn the market, most everyone just teaches you, hey, if it goes up, 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 okay? You know, really, we could push back on that. I think a lot of investors at first should learn not how to play if the market were to go up. I think the investor might say, well, hey, if I get the direction wrong or if it just goes down in general, how do I protect capital? Because if you protect your capital, you protect your confidence. You protect your capital, you protect your time, okay? Now, what I'm going to do is I'm going to click on that now, the 44 cents. So now we can see these numbers, okay? The 52.5, there it is. All right, so numbers update. What do you know? So what's the risk on the stock from now until expiration? $1.55. What's the cost of the put? Well, cost of the put is about 44 cents, okay? So if we said, well, okay, so if we lose $1.55, the difference in the stock price and long put strike, we add the long put, grand total, $1.99. Now, I'm just going to kind of give you some numbers that we've talked about for 20 years. Yes, I am that old. Now, a couple of things that we kind of think about. When we think about the cost of the put, we like to kind of look at that cost of the put as how much you're paying for the put divided by the stock entry price, okay? So I'm going to repeat that. What's the cost of the put? Okay, 44 cents. What's the stock entry price? 54. And if we kind of said like, hey, if most of these examples, given 20 to 40 days expiration, given that the investor is probably buying the put with a delta 30 to 40, if that cost of the put is about 1%, that's probably about the minimum, okay, that you'll find. If we found something was like 1.5%, we would just say that's medium. And if we, for example, said, hey, this is 2%, well, this might, for some investors, be the cap that they're willing to pay. And could you buy puts that are more expensive and that percentage would be high? Sure. It just affects your break even. Now, on the downside, if we lost, let's say, 3.68%, when we look at that, if the investor lost 3 to 5% of stock price, stock entry price, this is for some investors, they might say this is a small loss. Now, I'm just saying that some investors would probably say that's a pretty small loss. If the investor, let's say, lost 5 to 7% of stock, 5 to 7% of stock entry price, I think many investors who have some experience might say it's maybe more of a medium loss. If they lost, let's say, 8% plus, it's really kind of becoming more of just a bigger loss. Now, when people talk about, let's say, losses, they're kind of stating it in terms of percentage terms, okay? Now, I am not always saying that, oh, this one is, if you buy a stock that's elevated off support, you might actually have a bigger potential risk. But sometimes, if we look at this strategy, in both of these examples, they're kind of in that lower tier. Now, when we look at, let's say, what we bought the stock for, 54.04, there. How much we buy the put for? There, 44 cents. What's the break even? So at expiration, we need that stock to be at 54.49 to break even. So we can play the what if game. What if the stock is at 53.49? Well, that would be down $1 or $100. Wonder if the stock was at 56.49. Well, you'd be up $2. And by the way, this begs the question. If the stock goes up to 56.49, What happens with the long put at expiration date? Well, at expiration, the long put could expire worthless, and the investor still has the shares of stock. Okay. Now, one of the questions is, what about the following week? So include ex-dividend date. Well, the dividend payment drops the stock price by approximately what the dividend is. To prevent arbitrage, the dividend is already priced for that dividend payment. If that was not the case, people would just go out there and buy puts with a guaranteed drop in the stock, or what they think is guaranteed. But if you've ever tried to do that, it seems like, oh, yeah, if I just buy puts, the stock's going to have a dividend next week. Stock drops by approximately by what the dividend is. And the investor that has long puts thinks, where's the money? Well, the puts are priced for that dividend payment. Else there could be arbitrage. Okay? So if you've ever done that, you know what I'm talking about. You're thinking, hey, where's the gain? Now, what I'm going to do in this case is example number 2. Okay? We're going to buy the shares of stock on Mo and have a long put. Now, remember, does this have a maximum gain? It doesn't. Okay? Does it have a defined risk? It does. Is this a strategy that has is it a bullish trade or a bearish trade? That's a question. Is this a bullish trade or a bearish trade? Well, you got long shares of the stock. Okay, so we know if you buy shares of the stock, you have 100 shares of stock, 100 delta. If we, for example, let's say also buy the put as well, that is what's going to create that horizontal line. And now what you're going to notice is there is a max loss built in. So if you look at this and said, hey, if it went down, 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 the stock went to the left, there is a max loss built into the trade. Why are we bringing this up now? Well, it's because when the VIX is low and starts to go up, if the investor says, look, I still want to buy some shares, but I want to have a right to protect the downside for not infinite, for a period of time. And that period of time is really to the 21st of March. Okay? All right. Now, what I want to do, now, by the way, you and Brent, myself, we've been investing for a long time, okay? I would say if someone asked me, hypothetically, what's a strategy that the investors probably use perhaps the least? I think it might surprise you that buying puts is probably a strategy where the investor might know about it, but doesn't really apply that, okay? Now, they become more attractive if the implied volatility on that stock is lower, and we talked about that before. So in our second trade example, we're going to actually buy the shares of the stock, and then number 2, buy the put below. So what do you want the stock to do? Well, clearly we want it to go up. Okay. Now, I'm going to also kind of speak to here. We got to go to an example. So first off, are there any questions on that? Any questions? Okay. Now, if we take a look at this, and let's go back to kind of the comment. When we take a look at this, let's go back to Mo just real quick, and let's bring up what was the delta on the position. So when we say the delta on the position, we're talking about the shares of the stock and the long put. The shares of the stock, that's bullish. When you buy the put, that's bearish. And when you put those two together, it creates the delta, okay? The net delta of the two, and that is at 73. Now that delta does not stay constant. It can change, okay? Why? The delta on the shares of the stock is not changing. It's the delta on the option that is changing based upon if the stock were to go up or down, okay? So in other words, if we get the direction right, we become more right, okay? If the stock were to go down, the put becomes more protective, which is kind of interesting, okay? Now, what I'm going to do is let's also kind of go back to the taller example on example given, Amazon. So if you look at Amazon, we have 100 shares of Amazon. Now, what you're now going to notice is Amazon has been going down. And there's some stocks where the investor says, look, I don't want to get out every time the stock goes down. Because if I did, I just constantly be trying to really get back in shares all the time, okay, or new positions. Now, what you're now going to notice is this is a caller. We have shares of stock, see the first row, and we have the short call. Now, what might the investor do with the short call? The foundational understanding, when you sell a call or you sell a put, you receive an upfront credit. So what? Well, so what is you can only make $297, okay? So if you take a look at that, if that were to drop down closer and closer to zero, the investor might say, well, geez, I might consider taking that 73% and trying to stuff it in the pocket. Now, that $218 could help theoretically reduce, the average price of the stock. We've already rolled once. Now, the previous call that we had made about $450 and reduced this stock theoretically to about $233. Well, if we buy that call back, which we're going to, buy it back, create closing order, we're going to buy it back. So if you buy it back, you're trying to harvest that $219 gain. We're going to show that. Let's do that. And we're going to go to the bid price, confirm send, and we're going to send the order. Now, could the investor try to sell another call if they wanted to? I'm going to show you that. Now, if we sell another call, we're going to go right back to the let's say the March expiration again, and we're going to try to sell a call with a delta of, let's say, 30 to 40. 30 to 40 delta tends to be something that is out of the money. On the call, that means above. Okay? So when we look at this, in this case, we're going to come back in and say, well, look, we're going to sell, okay, try to sell the 230. Now that is not filled yet. So I'm going to come back in so that just fills and just make sure it fills and unlock it. Just make sure it fills. We're going to roll this call down to the strike of 230. Okay? Okay, it fills. I'm going to click on the 370. We're going to say we're going to sell the call at 330. Confirm send. There it is. Now, on the first call we got, it was $4.50. Second call we actually did was about $2.10. So we've been able to reduce the stock price to about probably break even, theoretically, about $2.31. So right now we're down about $9 on the shares of stock. But let's go back to the point why we wanted to look at this. We have a long put. If we let the stock close below the strike price on the put, stock price is right there, and what you're going to now notice is the long put is at 227. If we let the stock close below the long put strike, what's going to happen most likely? Well, the shares are going to be sold. If you have a long put, what that's going to do is it's going to sell 100 shares, and if you have 100 shares, okay, you won't have a position. Now, if the investor said, well, James, I want to roll this put out in time. Now, I don't normally do this, but for our example, I think it would be a good discussion point, okay? So how would the investor roll the put? So when we say roll the put, in this case, if we have one contract, we're going to sell it and buy another one. Now, why is the investor maybe not so freaked out maybe about, let's say, Amazon here? Amazon is just kind of pulling right back down to the horizontal support. So the investor might say, look, I'm not really freaked out. Yeah, the stock went down, but it's just kind of pulling down to horizontal. If it goes down below 220, maybe that might be the investor saying, look, I'm going to be kind of more concerned. I'm going to right click on this, create a rolling order. Rolling order just means we're going to get out of what we have now and enter a new position. We will. We're going to click on that. We're going to say, in this case, we're going to sell the 21 February. That's the one we have now. And then what we're going to do is we're going to buy a new put. So if that stock were to drop down below that 220 strike or maybe the 215 strike, yep. So in this case, what you're now going to notice is in this last example, we're going to take this March 21st, And now what we're going to do is we're going to pick the 215 strike. Okay. And now what we're going to do is we're going to roll that collar forward in this example. And now what you're going to notice is there's a cost to that because we're buying more time. Now, what's your homework assignment from this? I want you to go out and we've talked about collars. We've done many of those. Today, I wanted to add that wrinkle to practicing married puts, buying the stock and buying the shares at the same time. Your homework assignment is to go out and find 2 examples of a stock that's bullish, above support, buy the put. So you're going to have 2 defensive strategies. You're going to have a collar strategy, which we've talked about multiple times, and a married put strategy. And I want you to get comfortable with this strategy, okay? So I'm out of my time here today, but I wanted to kind of really go over the details of this. Quick reminder that if you have not subscribed to the YouTube, our page on YouTube, Trader Talk Schwab Coaching Webcast, make sure that you do that right in the middle of the page. Quick reminder that if you did not realize, we do have a playlist, okay? And this will give us the previous classes from this session recorded. And also, quick reminder and last, that remember with what we discussed, it was done for example illustrative purposes only. Gave you a homework assignment to go out and practice 2 married put examples. Thank you, Brent, and thanks to all of you. And stay tuned for our next session coming up at the top of the hour. I'll be back tomorrow on ETFs with Kevin Horner. Thank you, Brent. And stay tuned for our next webcast coming up next. Take care. Bye-bye.